Welcome back. Namibia's central bank has taken control of SME Bank Limited, a lender focused on small businesses in the southern African nation, citing investments that can pose a risk to the bank's stability. The central bank says in a statement that certain investments made by SME Bank did not conform to sound investment principles. The SME's chief executive and other senior managers were also removed on Wednesday. The central bank says it will further investigate the affairs of the SME Bank, which is majorly owned by Namibia's government, but lending and other banking activities will continue. However, the SME Bank is yet to comment on the issue. Data from the Central Bank of Nigeria shows that Nigeria's Purchasing Managers Index contracted at a faster pace to 44.6 in February from 48.2 in January. In a similar pace, the composite non-manufacturing PMI decelerates at 44.5 as against 49.4 in the previous month. The decline, which indicates quicker deceleration in manufacturing activities across the country, also represents additional pressure in the non-manufacturing sector. With the new data, both segments of the economy have performed below the 50-point expansion threshold of the reading. Given the February circumstance, analysts have also predicted that a substantial recovery is currently not in sight. And with the PMI numbers released, how will this play out on domestic commodities going forward? Well, let's talk to a senior analyst at financial derivatives company, Bolanle Olutosin, for more on this. Thank you, Bolanle, for joining us on the program.
Thank you for having me.
Now, so with the PMI and the FBN, with the CBN PMI and the FBN PMI figures released yesterday, what does the data tell us about the current state of the manufacturing sector?
Okay, so the CBN PMI contracted to 44 and from 46, and the FBN PMI expanded from 48 to 50. These figures I've given mixed reviews, but what we know is that in February, diesel prices were about 270 naira per liter. Power, which is also a major aspect for manufacturing companies, only increased to 4,000 megawatts towards the end of February. So for the first 3 weeks in February, power was an issue. Diesel, like I mentioned, is also a huge cost component for many manufacturing companies, and this increases their operating costs. Road transport network has not improved, which it's not enabling for manufacturing companies. And we've seen that the forex issue for manufacturing companies have also not been addressed. So these conditions or these issues that have laid out are not, they don't provide a good operating environment for many manufacturers. So leading into commodity prices, what we've seen is that these conditions do not enable the increase in supply of goods, which could affect the prices of these goods, because once supply is down, price increases. So we do expect that if nothing is done, the prices of these commodities would be sticky upwards.
Now, based on the GDP figures for manufacturing and the recent PMI data, when do you expect the manufacturing industry to return back to positive territory?
Okay, so the GDP figures for the manufacturing sector in real terms were performed well, if I could say that, to about -2, although remained in the negative territory. In Q3, it was -4%, but in Q4 2015, it was about 0.38. So although, manufacturing sector has improved in Q4, it hasn't, performed greatly compared to the way it performed in 2015. We do expect that if nothing is done, we would only see improvements, from Q4. But if, the government is creating policies to enable economic activity within the manufacturing sector, we should see positive growth. We should see a positive trajectory from Q2 onwards.
Oh, what about the new CBN forex policy? Is it likely to have any impact on the manufacturing sector?
Okay, so the new forex policy only addresses invisibles within the economy, and invisibles account for only about 25 to 30%. Tradables, on the other hand, which, the manufacturing sector comes into play, accounts for 70%. So the current Forex policy has not necessarily addressed, the Forex scarcity in the manufacturing sector. However, we have forward contracts. There was another bid for forward contracts on Monday. But then the issue with the forward contracts is that, these companies do not know when these forward contracts would take place. So there's an uncertainty when it comes to, when forward contracts would, occur. And it puts more pressure on the spot market. Although the spot market has improved, it's about 305, but the parallel market has improved to 455 naira per dollar since, this effect. So there'll be an indirect impact via the parallel market if they choose to, visit the parallel market to access Forex. But if they want to get the official rate, the forward contracts have, helped aggrieve, length.
Bolanle Olutosin, senior analyst at the financial derivatives company. Thanks for coming on the program. Now, the Nigerian Stock Exchange is set to host Nigeria's first FX-denominated bonds of $1 billion today. The Eurobond will be issued under the country's newly established Global Medium-Term Note Program on the floor of the exchange at 2 p.m. local time. Well, let's see how this is impacting the fixed income market. And Ayodeji Oyeni, who's a fixed income dealer at Rand Merchant Bank, joins me now. Thanks, Ayodeji, for coming on the program.
Thanks for having me.
Now, what is the listing of the Eurobonds how is it likely to impact on the fixed income market?
We don't expect it to have so much impact, but the major impact we foresee is just the diversity in terms of products being listed on the exchange. It's currently trading on an OTC platform, and it's also listed on a London exchange. But in terms of the local, being available for retailers, because of the volume as well, we don't expect to see so much impact from the retail investors. So it's just there available so that when investors want to take advantage of it, it's there to be traded on.
Oh, so what sentiments have you observed in the markets today?
In the local currency bond market, it's been on a quiet note, and that's the reason for this is because there's been a backlog of unsettled trades which banks are trying to clear. So today's trading has been very quiet, but the major event was the auction of yesterday, which printed close to the 1st of March levels as well. So we had a total of 310 billion being sold. The yield for the 1 year, most especially, printed at 22.68, which is still very attractive for investors. And we see most investors trying to position for the base effect on inflation, which is expected to be released. The February inflation is expected for 15th March, so we see investors trying to position for that. So we envisage that, there's going to be some buying sentiment as soon as the market resumes trading fully, which is on Monday.
Ayodeji Oyeni, fixed income dealer at Rand Merchant Bank, thank you so much for your time. And that's our program today. Thank you so much for watching. I am BC Adebayo.